All right. Welcome. Welcome back, guys. Day 4, you made it. You have survived 3 days with Jen and Stacy. But alas, there are 2 days left, today and tomorrow, and we are so excited to be here with you today. Woo, we've done a lot so far, and there's still so much to do. All right, so I know yesterday was, I knew going in, I was like, oh, this is gonna be a long one. I'm gonna try to make today a little bit shorter, so just so you can get to work and get going on your homework and all the good stuff. But I was super excited. Today, we are going to be talking about analyzing deals, and I'm going to touch on how you submit offers when it comes to doing apartment buildings. And then Jen is going to come in and be talking about success planning. And it's just, I mentioned it yesterday, but in our last challenge, the section that Jen does and the way she delivers it, and she makes it so crystal clear with such easy to understand ABCDE steps to planning your business and your activities so that you actually get momentum and traction. Like, it's incredible. And it seems like, well, it should be intuitive, right? Don't people just know that? I mean, you would think, but we don't. Like, we're just not naturally wired that way. So I'm really, really stoked and excited for you guys to get to hear from her today and for her to lay down all that fantastic knowledge that's coming your way. So, all right, but first things first, we're going to be starting by talking about financial analysis. So first thing I'm going to do is going to lay some foundation. Make sure you have pen and paper and ready to rock, because there's going to be a lot of notes to take. So I'm going to start by just laying down the foundation, like information, pen and paper. How do you calculate all of the different things? And then I'm going to bring up the financial analysis. It's a basic, quick analysis calculator. And it's not something you would use if you're going to submit an offer on a deal. You're probably going to want to go more in depth, but it will, at a minimum, give you a ballpark idea of whether the deal is worth looking at. Okay, so we will go through that today as well. And you can get a copy of that tool and have that information for you in the homework. All right, let's get started. All right, so first things first. The very first foundation, we've talked about it before, is net operating income. So in the world of apartments, there are certain things that are calculated that are specific to apartments. Net operating income is really used for anything multifamily, but you'll hear it referred to a lot more or referenced a lot more in apartment world. So net operating income is the revenue of the building. So any revenue coming in, rents, vending, storage, laundry, anything else. Okay, all the revenue that comes in from operating the building minus the operating expenses. So operating expenses are going to be things like property management, property taxes, insurance, maintenance, what else? Advertising, tenant placement fee. All right, so anything that you're going to have to pay in order to operate the building is going to be an operating expense. If you're doing a larger apartment building, and let's say you actually have a leasing office in place and it's a large enough building that you would have employees, then the expenses start to really expand because there's a lot of different costs that go into running a larger building like that, above and beyond just the property management fee. Oh yeah, utilities. Utilities is another one. All right, so you take all that money that's coming in, you subtract all that money that's going out. And the one thing I haven't mentioned, and this is on purpose, is the mortgage payment. So the mortgage payment is not part of the net operating income calculation, because the whole idea of net operating income is how does the building perform regardless of how it's financed. Because the one thing that's going to be different from investor to investor is how are you financing it? From like what type of loan are you getting, to what amortization period, to what interest rate. There's so many different factors that net operating income isn't intended to answer every question for every person. It's going to tell you this is how the building performs before you have to make a mortgage payment. Okay, so that's the first foundation. All right, next part that we're going to talk about is just the debt service and what impacts the debt service. So for starters, your debt service is going to be based on the loan amount, right? Not the purchase price, because your debt service is a function of what you owe the bank. So your purchase price minus whatever down payment you're putting down is going to be the loan balance, and your debt service is going to be based on that and a couple of other things. We'll talk about that in a second. So the reason net operating income doesn't include the loan, you can see right here, like let's say that you're purchasing the property for $1 million and one person is putting 30% down, 300,000. Well, their loan balance is going to be 700,000 and their payments are going to be based on that loan amount. Well, what if there's someone else who is doing a 1031 exchange and they're able to come in and put down 450,000? Well, now they only have a loan balance of 550,000. So that means their mortgage payment is going to be lower than the other person, right? So that's why net operating income is completely separate from debt service, because debt service is such a function of the borrower, how much down payment, etc. Some of the other things that are going to impact debt service are there at the bottom. It's your loan balance, the amortization period, the interest rate. So the amortization period, we talked about that yesterday, if you remember. Amortization period is the time frame over which you're paying off the principal balance of the debt. So in the apartment world, 25 years is going to be the most common amortization period that you see. And so 25 years is 300 months. So every month for 300 months, when you make the same payment, every month your principal balance is getting lower and lower and lower. And when you make that 300th payment, your loan balance at the end will be 0. If you were using or looking at a loan that had a 20-year amortization period versus a 25-year, do you think your payment would be lower for 20 years or higher? So the whole idea is, if you have a 20-year amortization, you're paying off the loan in 20 years. If you have a 25-year amortization, you're paying it off in 25 years. So if you're going to pay off the same amount in 20 years compared to 25, that's going to be a higher payment. So I hope that makes sense. Sometimes I just want to explain a little bit deeper so that even if you don't necessarily remember all of the exact terminology and what makes something go up and what makes something go down, is I want you to just think through, completely separate yourself from real estate for a second and just think logically. If I'm going to pay back something over 20 years, I'm going to probably have to pay more per month because I'm trying to pay it off sooner, right, than 25 years. Anyway, that's how amortization period impacts things. And then interest rate, of course, is going to impact your debt service. All right. So the next foundations we're going to be talking about is cash flow. So how do you calculate cash flow? So you take your net operating income, revenues minus expenses, minus your debt service, and that equals your cash flow. Okay, so cash flow is the net, meaning everything has been paid. All of the expenses are paid and the debt service is paid, and what is left is yours. That's your cash flow. And whether you're using that to make your car payment, make your house payment, put in savings, use for retirement, or just sticking it away for a rainy day, it doesn't really matter. Just cash flow is the cash in the bank, effectively, that is left over after everything has been paid each month or each year. All right, so now let's talk about all-in costs, because all of these things are going to be part of the calculator that I'm going to show you in just a minute here. So all-in costs, this is everything cash related that you have to put into a deal. Okay, so cash related, think of it, you're going to put down your down payment, your closing costs, your lender costs, so whatever points and fees your lenders have. You know, I don't have it separated in here. When we're doing real estate, we kind of group it into lender costs, but I'll just call it due diligence costs. And not all of it is from the lender, because some might be an inspector, but anything that you put into the property during due diligence is going to be part of your all-in costs as well. And then impounds. And so we talked about impounds yesterday. Quick reminder, impounds are basically your property taxes, insurance, and property capital expenditures. Capital expenditure reserves is not considered impounds, but in my mind, it's in the same category because it's just money you're putting away every month that then they will pay out when there is cause to do so. And as far as property taxes and insurance, the cause to do so is whenever the property taxes are due, whenever the insurance is due. All right, so most lenders are going to ask for 3 to 6 to 12, sometimes months of impounds that they're going to hold so that they have the money in-house when it comes time to pay the property tax bill and the insurance. The one nice thing about that is that, you know, before I was doing real estate at a level where the lender was handling all of that, I would always have to remember when everything was due. And we're in multiple different markets, which at different points during our career, we have been in 7 to 8 markets at a time. That is very difficult to keep track of. I will tell you, operationally, it's not super easy to be working in that many markets unless you're at the level where you're doing apartment buildings and you have property management company, handling all of the bookkeeping, and you have your lenders paying the property taxes and paying the insurance, not because you want them to, just because they require it. All right, so anyway, all-in costs, all the money that you're putting out of your pocket. All right, so the reason we need to know what the all-in costs are is that's how we're going to calculate what our actual return on investment is on the cash that we have invested. So we call that cash on cash return. All right, so your cash on cash return is the annual cash flow. Everything in apartments is annualized. So you're going to take that very top one at the top, net operating income minus annual debt service equals cash flow, annual cash flow. And take that number, divide it by your all-in costs, and that's going to give you a percentage. And that percentage is basically your cash on cash return. So if you do this calculation and you see one apartment building has a 5% cash on cash return, and another one has a 9% cash on cash return, and another one has 14% cash on cash return, that's going to help you to kind of say, oh, okay, actually, I don't want to look at these. This doesn't have a high enough return, and let me go focus my attention on the one that stands a better chance of actually, helping me make some money on my money. Or, again, the higher the cash on cash return, the more likely you are to be able to bring in a JV partner and have there be enough to make it worth it for you to do the deal and for them to do the deal and for you guys to be splitting the cash flow. All right, next is purchase cap rate. So cap rate is short for capitalization rate. And the cap rate is a percentage, and it is a function of the NOI, or net operating income, divided by the purchase price. Okay, so it's interesting because if you have net operating income of $100,000, let's say, and the purchase price is $1 million, you're going to take your calculator. So if you don't have a calculator in your hand right now, go ahead and grab one. All right, so grab your calculator, put in 100,000 divided by $1 million, and you should get 10%, right? So let's just say that we're in another market, maybe a more expensive market, but the net operating income is still 100,000. But let's say in this market, the purchase price is 1,500,000. So what does that come out to be for a cap rate? Basically 6.7%. But that's just how it is when it comes to apartment buildings. If the market is more valuable, then the prices are higher. The net operating income might not be higher. So those are markets that have a lower cap rate. Markets with a lower cap rate are the ones that tend to be prime for doing value add opportunities. You're not really going for a stabilized cash flow purchase in a market that has a low cap rate, because the lower the cap rate is, the lower it's going to cash flow. So if your whole objective is cash flow, you want to try to find markets that have a higher cap rate so that you have a higher return on investment coming in. All right, so this is a little bit hard to grasp sometimes, but we have to go through it because this is going to be part of how you analyze deals. When you're trying to figure out, how much is a property worth? Because sometimes you'll look at listings and they don't have a price. All right, and they just like, well, we're open to offers. So what you have to do in that case is you have to figure out like what are things trading for in that market? What is the market cap rate? Because in most markets, you're going to see like cap rates are somewhat in a range. Like, in San Diego, LA, San Diego, you're going to see cap rates typically between, anywhere from 2.5 to maybe 4.5. So 2.5 to 4.5, that's kind of like the market cap rate. In other parts of the country, you'll see market cap rates that are between 8 and 9%. Right. So as you're doing that research in the market and you're trying to get your arms around, what do I think like the range, the market cap rate is, you'll pick a number that's somewhat in the middle of that for the purpose of what we're talking about here. And what you do in order to figure out like, well, what is this property worth? What is it worth to you, or what is it worth to the market? You would take that net operating income and divide it by the market cap rate, right? And that equals the property value. Where this is also useful and where it will come into play in your investing journey is when you are looking at a value add opportunity and you are trying to figure out, well, what is this property going to be worth in the future, so that you know whether to bother taking it down, is there enough profit in it? Is you're projecting out into the future, well, what is the property value going to be? So what you have to do is you have to look at, well, what is my net operating income going to be 2 years from now, 3 years from now, whatever time period that you're planning on selling? What will the net operating income be? And you should be able to project that because you know how much the rents are right now. You know how much the market rents are because you're doing the due diligence to find that out. So you should be able to get a projection of this is what the net operating income should be by year 2 or by year 3. And when you know the market cap rate, you can take that net operating income, divide it by the market cap rate, and that will give you an idea of what your future property value will be. All right, so those are some of the foundations. And what we're going to be doing next is, give me a moment. I'm going to pull up the analysis calculator, and we're going to go through some scenarios that you can get an idea for how to use this. And then part of your homework is going to be practicing using the analysis tool just to start wrapping your mind around where to go find the information from LoopNet or from the broker, from the offering memorandum. So it just gets you engaged in starting to look at deals. And what information do you put where, and what kind of return does it give you? So your homework is going to be tied to you running some analysis on some deals and recording that information in your workbook. All right, give me 1 second and we'll get switched over here. Okay, so this is the analysis tool that I was telling you about. It's in Google Sheets, so super easy to access. The first thing that you're going to do when you get the link is you're going to go to File right here and make a copy. Okay, and then you can put it in whatever folder you want in your own Google Drive. Okay, because otherwise you're not going to be able to edit it, and you'll send a request for permission to edit or access, and I'll get some email about it. But don't bother doing that, because I can't grant anyone access to the document itself, because otherwise it change it for everybody. So you just need to make a copy, and then you can change it all you want. All right, so let me just walk you through how it works, and then let's kind of play with it a little bit. All right, so everything that is in blue are intended to be inputs. Okay, now the reality is, because this is in Google Sheets, none of the cells are locked. When I had this in Excel, I had locked all of the cells that were formulas so that they didn't accidentally get changed. But in Google Sheets, they're not locked. So if you wanted to manually overwrite something, you have the ability to do so. Just be aware that you probably want to have the first one you get from us be like your master copy that you don't make changes to. And then from there, you make a copy, and you can save a copy for each property, or you could add tabs down at the bottom. What you can do is you click around here and you can say duplicate, and it'll make another one. But you want to keep one that's a master, because unless you're really good and you understand the formulas, you know how to write them. Otherwise, you don't want to change them, because it'll rock your world. Okay, so the inputs in blue, keep in mind, this is a free quick analysis calculator. There's all sorts of things that go on when you're doing like a serious in-depth analysis that go into a lot more detail than what's here. But it will, at a minimum, give you an opportunity to kind of start seeing, okay, like this deal, whoa, this deal is horrible, and this deal, all right, this one looks okay. Oh, and this one looks way better, right? And that's really the intention of it, because one of the things that it stumps a lot of people and keeps people in analysis paralysis is spending hours and hours and hours analyzing a deal, when really could spend all of 60 seconds, dump some initial numbers in, and see, oh, this deal's terrible, and then you wouldn't even spend any more time on it. But when you're new and no one has ever told that to you, and you don't know, you could literally crunching numbers for hours and hours and hours and can't figure out why it doesn't work. Well, it doesn't work because it doesn't work. And sometimes the seller, all the time, the seller wants as much as they can get for the property. And as the buyer, you want to get the property at the best deal possible. So there's always that disparity there. So using this tool will help you quickly assess whether you should even bother to go further in depth into the analysis. Okay, so for example, one of the things that is not in here, and I just laid all the foundation for you, but there's certain things that are not in here because it's too detailed for this quick of an analysis, right? It's in our deeper analysis, software that we have in our program. But so impounds are not here. Now, impounds are not an expense, but it is cash that's required. So just be aware the cash on cash return is probably going to be a little bit lower than what it shows here, because you are going to have to put up impounds most of the time with most lenders. But I guess not necessarily, because if you end up with seller financing or somehow have a bank that doesn't require it, but you're probably going to have some impounds. The other thing that's not here is closing costs and financing costs. So there's probably going to be some amount of money that you're going to have to put out, and it'd be in the form of an expense. It would be capitalized. It's something that would be considered part of the acquisition cost, like when you go to sell it, and for tax purposes, but it's not in here. So your cash on cash return isn't going to be identical. And I just want you to be aware that there are a few things that are just not in here, because it would require you to start delving deeply into the property to go fish out those numbers. And I just don't want you spending that kind of time up front. The deals you want to spend time on are the ones that if you've put in a whole bunch of deals and you're like, okay, of all the different deals, these 2 or 3 have the best numbers. Well, now let me go and, dive deep. Okay, hopefully that makes sense. All right, so if we have purchase price, I put $1 million purchase price in there. Let's say the down payment is 30%, interest rate 4.8%. These days you could probably get a much lower interest rate. Amortization period, 25 years, number of units, 16. It's calculating automatically the price per unit, and then you have your average monthly rent. Okay, so I recognize that in a 16-unit building, you might have some units at 500, some at 825. So the whole idea is just to come up with an average monthly rent so that you can effectively calculate the income. Okay, so if you want to just hard input the amount, you can do that. You would be doing it down here. I'll get to that in just a minute. Okay, so these are all of your inputs that will change depending on the deal you're looking at. So these are starting to just show you what some of the things are. In this case, the down payment amount is $300,000 because the down payment is 30% of $1 million. Okay, and so our loan amount is the purchase price minus the down payment. So $700,000 is the loan amount. All right, the next thing is the net operating income. Okay, and I put these little things over here on the right for you to remind you what the calculation is. But net operating income is the income or revenue. Revenue is another term, minus expenses. So in this case, what we have in the calculator, the assumption that's being made is that we're going to build in a 10% vacancy factor. And normally when we're doing a deep analysis, the vacancy factor is actually broken out separately so I can see it. But in this case, I just wrapped it all in. So what's happening here is it's taking the 16 units times the average monthly rent of $750 times 12, because we're looking at everything on an annual basis. And then we are multiplying it by 90%. So basically this income is net of vacancy. So if you wanted to, not have as much vacancy, you can go into the formula and you can change it, or you can just hard overwrite this number. You could do the calculation by hand, hard overwrite this number. Expenses. So expenses in apartments can vary a lot. Okay, so 40% is probably going to be the minimum that you're going to see, but between 40 and 50% is not uncommon. So right now there's 40% that's built in there. So if you want to increase it, you come up to the formula and you can increase it, or you can just hard enter the number that you want to use. All right, so right down here, net operating income, $77,760 is the difference between the income and the expenses. Okay, that's NOI. Annual cash flow is that number, $77,760 net operating income, minus your debt service. Okay, so this $47,000 is based on loan amount of $700,000 amortized over 25 years at 4.8% interest. Okay, so that, when you do the calculation for that, which I just built the formula into it for you, you'll see the annual cash flow will be the difference between the two. So in this case, it's $29,870. All right, now I have cash on cash return on down payment. So normally cash on cash return is all of your cash. Well, because we're not including impounds and closing costs and financing costs in here, I just have cash on cash return on the down payment, just to give you a ballpark idea. All right, so cash on cash return is the annual cash flow divided by the cash invested. So in this case, we're talking about just the down payment. So it's taking annual cash flow of $29,870, dividing it by your down payment of $300,000 to give you a cash on cash return of 9.96%. So the way it's going to show up in your calculator is going to say 0.0996. So you would take the decimal point and move it over to the right 2 times. So I'll tell you 9.96% cash on cash return. All right, and then we get to cap rate. Okay, so cap rate, you're going to take your net operating income divided by your purchase price, and it's going to tell you the capitalization rate. So this is the current, what you're looking at with cap rate right now is what is the cap rate at this price? So for example, let's just say I was like, oh man, I really can't pay, I have to have at least an 8.5% cap rate. It has to be at least 8.5%. So I wonder, how much would I have to pay for the property, or how much lower would I need to pay for the property in order to get my cap rate to get up to 8.5? Well, let me play with it and see. Okay, so at that point, you just go up in your calculator and let's try putting in, I don't know, 950,000, and let's just see where we land. All right, so I put in 950. I'm just leaving everything else there. Cap rate is 8.2%. Okay, so I'm getting closer. So let's try 900,000. All right, that gives me a cap rate of 8.64%. Okay, cool. That's over 8.5. Well, what's the most I could pay? Let's try 910,000. 8.55%. Okay, that's pretty close. So the whole point that I want you to see there is that by making any change up here to any of these cells, all of the calculations are flowing through so that you can kind of play with and see, well, I wonder what it would be like if it was 16 units and the average monthly rent was really 900, so it gives you the opportunity to play with it. All right, so that's cap rate. Debt service coverage ratio. So remember when I said debt service coverage ratio, the higher the better. This would be a very high debt service coverage ratio, much higher than what the bank would require. So that's great. But basically what you're doing is you're taking your net operating income and you're dividing it by your annual debt service. All right, so in this case, it's almost double, and that's a great position to be in. All right, so those are some of your basic calculations. So let's play with a couple of the other things. You see the impact of purchase price. Well, let me show you what some of the other impacts of purchase price were. Well, let me put it back to 1 million and then you can see. So, oops, one more zero. So if the purchase price is $1 million, then the annual cash flow would be just under 30, right? Here's the mortgage payments, almost 48, annual cash flow is almost 30. If I brought the purchase price down to 910,000, our cash flow went up to 34,000. Well, why is that? It's because our mortgage payments went down. All right, so the purchase price of the building doesn't impact the net operating income at all because it just doesn't matter. What impacts the net operating income is the revenue that comes in, the expenses that go out minus the mortgage. So the only thing that changed is the mortgage payment. All right, the cash on cash return on the down payment is now at 12.5% if we paid 910,000. What if it was back to $1 million? Then our cash on cash return is below 10. So it just gives you the chance to put in different things, see how it impacts the numbers. It will give you an idea of kind of what ballpark dollar amount that you're going to be looking at for purchase price. So let's just say that when you first looked at this deal, you saw that the purchase price was $1,800,000. Right. And so you're just entering the numbers just oh, I'm just curious. Let me just check out this deal and see if this is even worth looking at. So I'd look at 1.8 million. I'd come down here and I'd see, oh, cool. The cash flow is negative. Okay, I don't know if you guys know this about Excel. Some of you probably do, and some of you probably don't if you don't work with Excel a lot. If you see parentheses or brackets around a number in Excel, it means it's negative. So, which makes sense because our net operating income is 77,000, but our mortgage is 86. So, yeah. So I would look at this deal and go, pass. Right? There's really no point in doing much more analysis because you would have to get it for such a lower purchase price that it's going to be unrealistic. And it doesn't mean you can't play with it and come up with your 910,000 and make that offer, but it's too much. It's 50% of what the seller's asking, so it's not going to be probably received too terribly well. All right, so that's the quick deal analysis calculator. If you'd like to get a copy of it, you could message our admin, Jen Stacy admin. We'll also put the link in the unit 4. So that you can get it. And like I said, as soon as you get it, take a file, make a copy, and you can start using it, which is going to come in handy for your homework tonight. All right, so I hope you found that helpful. I know you'll find it incredibly useful as you move forward in your journey. So of course, when you get to the point where you're ready to write offers, there's a process for doing so that's a little bit different than residential. And maybe you have no experience at all, so you have nothing to compare to, but I know a lot of people, when you're getting into apartments, you probably already had some kind of residential experience. And if so, I really want you to understand the difference between how we submit offers when you're investing in apartments versus when you're investing in residential 1 to 4 units. So for starters, the way that it is most typically done, nothing is ever always, but most typically, your initial offer is submitted on a letter of intent. Now, a letter of intent is something you could literally download off the internet. I'm going to go through with you when I'm kind of done walking you through the process. I'm going to show you just an example one that will make available to you as well. But the process is you submit on a letter of intent. A letter of intent is a non-binding document that effectively the point of it is to communicate to the seller that you're interested in buying the building. All right, so the letter of intent is also used to do preliminary negotiations. Now, the way that the negotiations end up playing out could look like a lot of different things. It could be you write up this nice document and you send it, they send it back to you, and it's got like chicken scratch all over it and certain things crossed out and written over it. It could be that they send you an email back saying, we agree to these parts of the terms, but here's some other things that we would need to have. So you have to be very flexible in what it actually looks like. But some of the things that are typically on a letter of intent that are, open to dialogue and negotiations would be the price, the earnest money deposit. So the earnest money deposit is the money that you're agreeing to put upfront at title, so held by independent third party, until you're at the point where you're done with your due diligence and you're either staying in the deal or you're backing out of the deal. But no seller is going to take their property off the market without you putting up some capital to show that you're serious. Okay, so earnest money deposit is always negotiable. And sometimes people say, well, how much should I put up for earnest money? It's really just going to depend. Generally speaking, you're probably okay to start with between 1% and 3%. Starting a little bit lower gives room to negotiate, but the other side of it is starting lower doesn't have as much of a feel of being serious. So you just kind of have to get a feel for the seller, maybe through your broker, and get some advice on that. And then you would make your earnest money deposit offer. The seller can come back and negotiate it. So you might put up, hey, I'll give you $15,000 earnest money deposit. They might come back and go, well, we want 45, and you might settle on 30. Okay, so totally negotiable. The due diligence period is something that could be included in the letter of intent. So the due diligence period is the period between the day that both parties have signed the contract. So now it's an executed contract, which would be long after the letter of intent. Okay, so this is not the letter of intent, but you have an executed contract. You have X number of days. So I don't recommend ever doing anything less than 30 days when it comes to doing an apartment building, because there's a lot more due diligence to do and you need time. So during due diligence, you're looking at things like leases, rent rolls, a T12, which stands for a trailing 12-month financial statement. You're calling the property tax assessor to find out what property taxes are going to be. You're calling and getting insurance quotes. You're getting contractors out there, if it's a value add, to give you quotes. You're getting a building inspection, although you don't want to get the building inspection done until you've done all of the other due diligence and the numbers are working out okay. Because there's no point in spending, an inspection on an apartment building is a lot more than it is for a single family home or for even a duplex. So you don't want to spend money on the inspection until you know that the deal is good. Based on everything else. Anyway, my main point is that it takes a lot of time to get all that stuff done. And sometimes the sellers aren't giving you everything you need right away. And so it kind of ends up dragging on. So 30 days, I'd say, is a minimum due diligence period. And then you're going to want to have between 30 to 45 days after that to actually close if you're getting financing. So most banks are going to take probably a minimum of 45 days to close. Now, if you're able to do your due diligence early, like in the first couple of weeks, the seller is super organized, gets you everything, you go through all the information, everything looks good, then you might start the process of funding and going to your lenders a lot earlier. But if not, you might not even start that process until the latter part of your due diligence, and the lender takes time. It takes some time to close. So just make sure when you're making your offer, you give yourself enough time to close on the deal, because here's what you're risking. Of course, your broker is probably going to advise you to, and I would do the same. You're going to put some kind of financing contingency in there. But the thing that you're risking when you make an offer and your earnest money deposit, and you say, I need this much time for due diligence, and then I'll close by this date. If you do not close by that date, and you've not negotiated additional time, and it doesn't fall into any kind of contingency that would allow you to get your earnest money deposit back, you could lose it. And to us, that's just not acceptable. That's never acceptable for you to lose your earnest money deposit. So you just want to make sure you're not putting too much pressure on yourself to close the deal faster than you realistically can. What else? Oh, then financing. Financing is another thing you could do. So the way I used to teach letters of intent, I would teach an ABC offer. Now, the one I'm going to show with you right now isn't really set up for ABC offer, but I'll still tell you about it just in case it becomes relevant. So an ABC offer is when you do a letter of intent and you say, I'm open to how we're going to, do this. I can give you a cash offer, which that would have to be a hell of a deal, because that means you're going to have to legitimately raise a boatload of cash. But I can give you, A would be cash offer, which would be the absolute lowest offer. B would be conventional financing, where you put down, 25 to 35%. and the bank is funding the rest, and that would be a kind of a middle price. And then C would be seller financing, and this would be the price, and that would be the highest price. Because the whole idea is if you can get seller financing with the seller and not go through the bank, you're going to save a lot of money just in all the costs from the lender and all the money you have to put up in the form of impounds and capital expenditure reserves and everything else. So generally speaking, most people are willing to pay a little bit more for seller financing. One, because man, it sure makes your life easier. But two, you do save a lot in the form of costs. So anyway, in the letter of intent, the way I'm explaining it now before the ABC offer, the financing part could just be where you saying, I'm interested in having the seller carry, 80% of the loan and I'll bring 20% to the table. Or I'm going to go get a loan with 25 to 30% down at 4.5% interest rate. So you can put the financing in the letter of intent. And actually, I guess what you could do is under the financing part is you could create kind of an ABC scenario. That would work too. So initially you go back and forth with the seller. Usually it goes back and forth a couple of times. Don't expect that you and the seller are going to come to an agreement right away. Sometimes you do, but sometimes it takes weeks, especially if they're legitimately interested in your offer, but you just haven't quite landed on the right set of terms and everything else, but you can tell you're both interested and you're getting closer. It could take weeks. I remember when Battelle, the girl I was talking about yesterday, who closed on the 9 unit and is closing on her, taking over the other 9 unit February 1st. When she was going through negotiations with the seller, it was weeks. It was weeks. And I remember one night she had sent me a Marco Polo and she was like, oh my gosh, I'm so tired of negotiating. And I think I'm fine just accepting blah, 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 whatever it was. I can't remember what it was at the time, but I'm fine accepting that. And I just don't want to lose a deal. And I'm tired of negotiating. And I was like, I don't think so. You're absolutely not done negotiating. There's still room. And frankly, if you just give up right now, you could literally be leaving $25,000 to $50,000 on the table, or you're bringing to closing a lot more money than you want to, which then makes it very uncomfortable when you're trying to renovate this property. So stay in there and keep negotiating. The fact that it's been a couple of weeks and you're close, the seller's not going anywhere at this point. So just stay in it. So just understand going in, sometimes the negotiation process is a couple of weeks, even in the letter of intent phase. Hopefully not, but if it is, don't be shocked. And then the contract part. So when the letter of intent is agreed upon and everyone has the terms, then what the brokers do is they put that into a contract, like a complete contract. Now the contract is somewhat limited. Like it has all the normal terms, but you're going to have an addendum that goes with the contract that lists all the different things that you're going to want for due diligence. Okay, so your addendum is going to ask for things like the last couple of years of rent rolls and T12s and their tax returns and a copy of the property tax bill and a copy of the insurance bill and et cetera, et cetera, et cetera. Okay, so when you get to that point and the contract is done, the addendum is done, you're going to review everything. You have to review everything. Don't ever make the mistake of thinking that because the broker is experienced that everything is right. You're the buyer. So if there's an error and you close, the error is yours to live with. So it's your responsibility to review it and make sure everything looks okay. But anyway, so let's say you look at everything, there might be a couple of changes. You have your broker make the changes first, and then you go ahead and send the contract and the addendum, your broker does, to the seller's agent, and then the seller's agent sends it to the seller. At that point, there's usually more negotiating that ends up happening because you're always going to ask for more things in the addendum than the seller's going to want to give you. And it's a bit of a back and forth. So I just want to prepare you for what's realistic, because I think a lot of people, when you're going into it, especially if you have residential real estate experience, that's usually no more than like a day or two or a couple of days max. It's not so much back and forth, but in apartment world, it is, because there's so many different moving parts. All right, so give me a second. I'm going to pull up for you a sample letter of intent that will give you guys access to, so that if you need one, you have it. Okay, so here we are. So this letter of intent is in Google Docs. You can message our admin, Jen Stacy admin, and she can send you a link so that you can get that and start using it. So at the very top, it has the date, the property address, and then you can basically customize it. So the purpose of this letter is to set forth a non-binding letter of intent between seller and purchaser for the purchase of real property, improvements, and personal property owned by the seller utilized in the operation of this property. If the terms and conditions set forth below are acceptable to the seller, then it is the intention of the parties to enter into a contract incorporating the terms and conditions within 15 days from the date of acknowledgement. Okay, so even that, it's like, okay, we've agreed on the letter of intent, and even now in the agreement, we're talking about 15 more days, right, until we actually have an agreed upon contract. All right, so the purchaser shall be, and then you put your name. If you have an LLC set up already, you can put the LLC name in there. If not, you can put your name. But the last part where it says and or designated entity, you need to leave that there, because you're always going to have well, I shouldn't say always, you should have a separate LLC for every apartment building. And one of the things that I'm going to do on Tuesday of next week is I have Clint Coons, who's one of the principals for Anderson Advisors, who is like the premier asset protection firm in the US for investors. They do asset protection, they do taxes, they do retirement planning for the purpose of for the purpose of purchasing real estate. My lips didn't work for a second there. Anyway, so asset protection is a really important thing, and you get into apartments, it's especially important. You don't be lumping a whole bunch of different assets together, because if something happens to one building and they sue the owner, you want the container of that LLC to be the only thing that's at stake. If you have other buildings, other property, you don't want those to be able to be touched. So that's why you'd have a separate entity. Anyway, so we're going to talk about that in a little bit, but I want all of you to go watch that interview. It'll be next Tuesday at the same time. We've been doing the challenge this week. I literally just in the last day and a half have been talking with his assistant and trying to get him in as soon as possible, because we just have the challenge going on right now. Anyway, asset protection is a super important part of everything that we do, because it's one thing if I can teach you how to buy it, but it's another thing to keep it. And he's such a good speaker, and he's so incredibly knowledgeable. I've known Clint Coons for about 6 years now, and I've always been kind of jaw dropped as just how much he knows. And not only that, he's a real estate investor himself, so he understands what it's like to be in our shoes, and he also understands what it's like to be in the shoes of someone being sued and not having the right asset protection in place. So he's going to come in, share a lot of knowledge on Tuesday, and yeah, I think you'll like it. But the reality is, you need it, and it's free, and it's just a benefit and a service to you. So I'm going to make sure that you're there. Anyway, I'll tell you where it is and just when we get to the end of it in homework. Anyway, so the reason you're leaving and or designated entity after your name is because when you get to the point where you're going to be closing on the building, so you're done with your due diligence, you're starting to get funding lined up, you're going to have an entity created. And ideally, you'd have an attorney do it. If you're getting into apartments, it makes sense to invest in an attorney. The reason you need to have your name and or designated entity is because title is going to need to look back at the contract and see that it's okay for you to change the vesting of the property to whatever LLC. But the thing is, when you are first making your offer, you probably haven't created it yet, so you don't know what it's called. So you need to leave and or designated entity in there. All right, and then you have the purchase price, whatever the proposed purchase price is, the earnest money deposit, financing, inspection period, settlement period. Okay, settlement period is closing period. If the above meets with your approval, please execute in the space provided below and return to the undersigned. This letter of intent is open for acceptance for 3 calendar days from the date of the LOI, and it has a place for buyer and seller. All right, so this is something that you can use, you can add to it, you can delete from it, like go ahead and knock yourselves out. This probably isn't going to come right away because you're probably not going to be making offers like immediately, but when it does, it's a nice tool to have. Your brokers might also have a form that they're comfortable using, and that's okay too. Just make sure you read it and that you understand what's in there, and anything you don't understand, ask about. All right, so I'm going to go ahead and hand it over to my partner in crime, except we don't do any crimes. Jen is going to share with you something that is just so incredibly powerful when it comes to running your business and really setting intentions and creating a plan that you execute in such a way that allows you to actually reach your goals. Some of you know this because you've been around us long enough, but some of you, you might be new to us, and we might be new to you. When Jen and I started Warriors of Wealth, we did so from the standpoint of, because Warriors of Wealth it's an education organization. We educate people in real estate, but that wasn't the point of doing it, right? When we decided to go ahead and get this going, the point was we have so many people that they learn real estate, they go to all these trainings, they do whatever, watching a ton of YouTube videos, they do all this like research and studying, but for whatever reason, they're never getting any results. Like they never close on anything. And we were like, you know what? We have to create something that helps take people across the finish line. That has to be part of what we build here. So we are very careful in how we designed our program to make sure that when people came in, it wasn't just to come learn more stuff. Of course, you're going to learn stuff because we have a whole training and I'm an educator and I can't help it teach you to death. However, the point of this is not to teach you more stuff, it's to get you in action. All right. And we're so passionate about everything that's possible for you. We know that our journey was super hard. It was super freaking hard. And, we just don't want you to, it just shouldn't be that difficult. It just shouldn't be that difficult. And that's part of what we're doing this for, so that you can get a leg up and get going. But one of the beautiful things about Jen and I and coming together and putting all of our experience and the things that we're passionate about together is I'm very prescriptive about the way that you do things in real estate. A, B, C, D, E, F, G, put a period here, cross that T. That's my style. And the intention is for it to be absolutely complete, that you have everything you need. What Jen brings to the table is, look, because I'm not good at strategy, high level strategy. That is just unfortunately for me, that's just not my thing. It's just not where I have talent. I have talent more in the details and being very methodical, ABCD. Jen is very, very, very good at strategy and building out a model that allows you to go from, oh, I really want this to happen, to, oh, it's done. It's already happened, but in real life, because of how she lays it out. And I'm really excited for the section she's about to teach you guys, because I know it's going to be just as meaningful, if not more meaningful, than all the technical stuff I've been sharing with you. So give us just a second to get this PowerPoint back up after this letter of intent. And I'm going to hand it over to Jen Conkey.
All right, everybody, you get me now. So my biggest thing is about mindset and routines. I fully believe that successful people have solid mindset and maintain good routines in order to keep that mindset solid, right? I mean, we all have good days and bad days, and just really want to talk to you about systems that you can put in place to bounce back when you're having those bad days or challenges and obstacles. I mean, everybody knows that there are challenges on the roller coaster of investing in real estate. And I really want to talk about how to set goals. So personally, I set goals by the quarter. I have my long-term vision of what we really want to accomplish. And then I could take that and think about, okay, so how am I going to break that down into a year? But when it really comes down to it, a lot can change in a year. So about January of last year, I mean, I had a whole different vision on where we were going, right? And then in March of 2020, we all got a curveball. And being able to be fluid and change and adapt to ongoing circumstances as they arise is just, it's the sign of a healthy mindset and of a solid planner. So if we're planning 90 days at a time, then it also helps us not get burnt out. It helps us establish milestones, goals, and we can celebrate along the way. Because if we don't celebrate, then we run into burnout. So what I want to talk to you guys about today is how to get into the routine of setting goals by quarter, how to establish your daily routines, and then how to know what hat you need to wear. And what do I mean by that? I just mean that, throughout the course of any given day, I have different roles that I play in my life. So in the house, I'm a parent, I'm a spouse. I also have myself, I need to take care of health, fitness, having fun, my own personal outlet. And I also am a real estate investor. I know, shocking. So all of those hats, I have to wear them and juggle them throughout the course of the day. Like when I first wake up, it's like, okay, cool. Going about that day, I put on my fitness hat, I hit the gym, I do all those things that are about self-love, meditation, getting ready for the day. Then I come in and I do my real estate investor hat from 10 to 2, get into the business and do those things. And I also have the parenting and spouse hat that I have to wear 24/7. That one I don't ever really get to take off. And there's a couple of visual cues that you can do that I'm going to cover that help you figure out, okay, what hat do I need to have on right now so that I can be 100% present. So without further ado, let's go ahead and get started. First thing I want to talk about is goal setting and planning. So as I mentioned, I plan in 90-day increments, so quarterly goals. In this specific realm, when it comes to apartment investing, I'm going to go over some very specific goals that you can come up with by quarter, by month, and by week. So this is just like an example, like a template, if you will. What I'm going to walk you through is like bare minimum. You can definitely do more. You can 10x the shit out of it if you want. There I go cussing. Quarterly goals. So the number of markets you want to enter. I've got to assess all these markets and choose one. How am I going to do that? How many do I need to do? The number of brokers that I'm going to have on my list for the quarter, number of properties to analyze for the quarter, number of offers to make, and the number of units that I actually want to close. Well, in order to hit those goals, you got to have monthly goals. So again, it's the market that you're going to enter, the brokers that you're going to reach out to, the properties you're going to analyze, the offers that you're going to make. And then that's broken down into further weekly goals. Same thing, number of brokers you got to reach out to, number of properties to analyze, and the offers to make. And if you treat this like a ladder, the very bottom rung, your weekly goals, if you get that under control, then you reach for the second rung, which is the monthly goals. And then bam, you'll hit the quarterly goal. So let's go through an example of what that looks like. So if we start at the very top and we know that I want to conduct market research on 10 markets and select at least 3 to enter. I want to build my brokers list to 30 brokers by the end of the quarter. And I want to analyze 30 properties, which is really just an average of 2.5 per week. I want to be able to make 12 offers per month minimum and close on 15 to 30 units. If these are your goals each quarter of the year, then you're going to be on the trajectory of getting 100 units, 100 doors within a year's time. So in order to do that, monthly goals, you got to enter at least into one market a month and figure it out. You might enter into a market on your first month in the quarter and land there and go, wow, this is awesome. This is perfect. Or you might find that you're analyzing a whole bunch of deals and it may not be the market for you and you want to go expand out and look at different markets. So you want to enter on a monthly basis, enter a market per month, add 10 brokers to your list, add 10 properties each month that you want to analyze, and then make 4 offers a month, which is basically, when you look at the weekly goals, you're going to be contacting 30 brokers a week, analyzing 2 to 3 deals per week. And I really want to just put this out there. That seems like a really low number, right? That number is not the number of deals that you're going to be getting and receiving from all of these brokers that you're reaching out to. But I mean, anybody who's done this before can tell you, and I'll tell you now if you haven't, you're going to get hundreds of deals. And at first glance, you're going to realize, I don't even want to dive into that one. So you might just end up analyzing like real analysis. When I say that, I mean like an inch wide and 4 miles deep, analyze 2 to 3 deals in a week, even though you may have received 150. So based on those 2 to 3 deals, I'm going to make an offer on one of them per week. This is just a blueprint for the bare minimum to get you going. Okay, so you can put whatever numbers in there you feel comfortable with. Now, in order to do all of that, once you have your plan and you have your goals and you know what you're going to do, the best way to stay focused is to have a daily routine. So I'm sharing with you my routine, my beginning of day routine, my middle of day routine, and my end of day routine. So I'm going to share with you what I do in the morning. I wake up, I have a gratitude journal, and I highly recommend that you get one. I could take a picture of mine and maybe you can kind of like look it up, but it's pretty helpful. I literally sit there and think about things that I'm grateful for in the morning. I set my intentions for the day based on my weekly goals. I literally every Sunday will sit down and plan the whole week out. And I will determine, what do I need to do this week? Every Sunday. I mean, that's all I do on Sundays is lay around and plan. But I will lay out the whole week and say, okay, what do I want to do this week? What do I want to accomplish? And then I will literally book it on my calendar, whether it be electronic or a written calendar for the whole week. So, okay, I'm gonna be doing this on Monday. This one I'm gonna do on Tuesday. And I just balance the whole week out, right? So every morning, because I do that, every morning I could wake up and I could be like, okay, this is what my calendar looks like. So now let me set my intentions for the day based on those weekly goals. And I ask myself these questions. I want you to ask yourself these questions too. Like, what is the most important task that I have to get done today and why? What will completing that task do for me personally, for my family, for my future? And what will it take to get this task completed? And this is the biggest question that I ask myself every day. What must I do that I don't want to do in order to win today? I ask myself that every day. You'll be surprised. We all know exactly what we don't want to do. And when you ask yourself this question every day, you fucking answer yourself. And then you go do the thing, which I call boiling the frog. We could talk about that another day though. Then I want you to visualize yourself successfully completing all tasks for the day. So what will you see, hear, feel, and smell or taste as you're succeeding throughout the day? How many different hats do you need to wear for the day? And at which points are you going to need to change hats? So then you got to ask, what can I do to maintain a high vibration when things don't go as planned? And I will tell you, every single day does not go as planned. So you've got to have some tools in your toolbox to figure out, man, I'm in a funk right now, a little bit triggered, got to figure out how to prop myself above that line. That is the perfect opportunity every morning to visualize yourself. Okay, these are the tasks I have to do. These are the hats I have to wear to do it. Where am I going to stub my toe and trip up and possibly get mad, frustrated, or give up because I don't like doing that task? And then what must I do in order to get through that task? And then visualize yourself doing that. And how can you maintain a high vibration? Well, personally, for me, that is all contingent on my midday afternoon routine. So here, let's go into that. Midday. Throughout the day, if things aren't on track, I absolutely make time, like a 10-minute personal check-in with myself, a meditation, making adjustments to the schedule that I need. I'm not even gonna lie, I woke up on Monday and forgot that it was a holiday and that we had kids at home. And we're sitting there trying to kick off a challenge, and there was a holiday that I forgot about. And so that's like a big miss. I had to make an adjustment and figure out how to get my mind right before we started the challenge. So those are little things that could happen to you too. Something might not go right, kids drop off at school. I mean, you name it, little things could add up. You have to just literally sit back, get yourself into like maybe some breath work. I do some deep breathing, relax my body, change my physiology, relax, clear my mind, and think about, okay, I already know what's not working, but what do I need to do? Like, what adjustments do I need to make to try to get back on task? And to get back on track, can I get back on track, or do I need to move some of the tasks that I was going to do to tomorrow? And really just check in with myself. If I feel like I can definitely still seize the day, then I'm going to visualize myself going through that process of, overcoming the hurdle, seizing the moment, and moving through. 9 times out of 10, that is the case, but there is that occasional time where I have to move a task to another day. And I visualize myself just successfully completing all tasks. I literally sit there and think, what am I going to see, hear, feel, smell, and taste as I'm succeeding for the remainder of the day? And then what am I going to do to maintain a high vibration when things aren't going planned? A lot of those things for me, I will literally just get up and change my physiology, jump around, go for a walk, just move. Anytime we're moving our body, it changes our physiology. Our heart rate goes up. We start breathing a little bit, like we can get a little bit more energy in us, try to shake things up. I also do something called gridding. So I will take a piece of paper and I will make 5 columns and 5 rows. So there's 25 boxes. And I'll just write down the current emotion that I'm feeling. Then I'll write down what emotion I want to feel next. And I just keep writing down the emotions until I can get to a place where I'm more calm and I'm more clear and I can move forward. Gridding works for me every time. So if you need a midday routine, or if you don't have one and you need one, those are just a couple of tips. I highly recommend checking in with yourself in the middle of the day. End of day, this is the best part. Like at the end of the day, you get to reflect on yourself. What went well today? What did I learn? And how will that benefit me in the future? And then based on that, based on what I learned and what I need to do differently because of, the things that went on today, I can plan for tomorrow. So I can ask myself, like, what adjustments do I need to make tomorrow in order to hit the weekly goals still? And what do I need to communicate? And who do I need to communicate with in order to make those adjustments? How do I need to show up tomorrow? And then I set the intention to do so before I even go to sleep. And speaking of sleep, it's the most important thing. Try to get 6 to 8 hours of sleep. Rest is super important. And for optimal performance, your body is literally regenerating itself while you're sleeping. So it's really important for you to try and focus on your sleep. Make sure you have an absolute bedtime and an absolute wake up time. And there's plenty of people out there that don't have hours of operation. I'm telling you, you got to get hours of operation for your business. And so from 10 to 2, I'm doing all things real estate investing. And then anything after 2 or before 10 is a bucket of time dedicated to something else. But my hours of operation for real estate investing are from 10 to 2. If you don't have that, make a schedule for yourself and then plan everything else around it. All right. So beginning of day, midday, end day. Super important to have those routines in place. Now, I want to talk to you a little bit about motivation strategies. So when I say carrot versus stick, what I mean is, I'm just going to give you just a quick example. Man, when I think about carrot versus stick, I have a carrot that I'm chasing. I'm setting a goal and I want to move toward that goal. And I'm going to chase that carrot because I know that there's a win in it for me. But when I have a motivation that is based on scarcity or fear-based, like, holy crap, I just got to hurry up and like get these deals underway so I can leave my 9 to 5 next week. Like, that's not going to happen. It takes a little bit of time, consistency, energy, effort, and focus. All of those words can be summed up in discipline to get to that goal. Well, but if I'm trying to run away from a 9 to 5, I'm not exactly running towards the good things. So I want you to think about what's the end result that you want and focus on that and move towards that. Don't look back and run away from the stick. Always be moving towards the carrot. You want to cast your vision. So I've been doing mindset calls. I give back to the community and I do a mindset call twice a month. It's the first and third Monday of each month. And in January, we literally kicked off, hey, we're going to go ahead and write a vision statement. We're going to write it as if everything we've ever wanted in life has already happened for us. And we're going to have vision boards and we're going to read that vision statement every single day. It's something that I do in the morning, wake up, look at my vision board, read my vision statement, let it cross my throat chakra, say it out loud. I'm literally asking the universe for what I want. And then I'm going to be able to focus on what I want because I'm focusing on the result, not the how, right? Most important when it comes to motivation, and this is where a lot of people sort of get tripped up, stub their toe and fall, is most of us, we are such go-getters that we don't plan time to celebrate when we actually hit our freaking goal, right? So this is what I always suggest. You want to plan this whole thing that you're going to do for the quarter. And that comes down to weekly and monthly goals. I'm just saying every month, when you're 90% to your goal, celebrate then. Celebrate when you're 90% to your goal and then ask yourself, okay, what's next? And always be planning, always be raising the bar, always be moving and improving. You're not going to just hit the 100% to goal and sit back and go, awesome, this is awesome, I did it, right on. Because a lot of times what happens, once you've hit the goal and you're not in motion, right, the law of inertia, keep moving, you'll rest on your laurels, you'll get complacent. And that's how a lot of people will get into real estate, get to 12, 20 doors, be like, cool, I've arrived. And you know what, if that's okay for you, cool, stay there. But I know a lot of people don't want to stay there. I know a lot of people want more. And when you want more, you have to celebrate when you're 90% to your win and then plan what's next to close the gap on that 10% and then keep going. So I really want you to think about what are some ways that I can plan to celebrate. I'll tell you what we do. We go to Vegas. We go to Vegas and we have fun at the poker tables. When we hit goals, we plan a trip, like a small little trip. You could do something as simple as, hey, I'm going to go get some, ice cream, whatever it is. Or, hey, I want that cool pair of Nikes, whatever it is. Plan your celebration based on the milestone that is most important for you. Like what's going to move the mercury most in your business. You plan that, you hit that goal, you celebrate. Okay. And always think about it, literally 90% of the goal, I'm celebrating now. And then what do I need to do next? Because I'm almost there. And once I'm almost there, I got to be thinking about the next thing, but I still need to celebrate this thing. Okay. Plan to celebrate. Don't get burnt out. Hope that helps you. I'm going to give it over to Stacy. She's going to talk to you about day 4 homework.
All right. So who's ready to talk about homework and extra credit? And guess what? We've added 2 additional extra credit opportunities. You will not see them in your workbook because at the time that I created the workbook, I hadn't thought of them. One of which is the asset protection interview And I didn't know about it because that just happened. And I'm super excited for you guys. All right, so let's go through it. So those of you who have stuck through it through the end, you are going to be in the best position to get all of the points available. All right, so homework. To get a copy of the calculator, you can text the word tool to the Warriors of Wealth hotline number, which is 619-373-8461. It will swiftly send you a link back, which will be the calculator. You can do that, or you can message our admin. All right, either way on that. Next part of homework is I want you to find 3 properties. It can be properties that were sent to you by brokers. It can be properties you find on the internet. It needs to be something that's at least 5 units. Okay, something that's going to work in the world of commercial financing. Right, so you're going to find 3 properties and you're going to run a basic analysis on them. And basically what I mean by that is run them through the calculator. The whole purpose of doing that is to give you some reps and using it, because a lot of times what keeps people stuck in analysis paralysis is, well, I don't really know how to do it. Okay, well, guess what? You're going to do it, because that's how you're going to get points. You're going to do it, and then you're going to be like, oh, yeah, okay, it wasn't so hard. And you're going to do it again and again. You're going to start getting faster and faster. And then pretty soon, you're going to be like, what was I so scared of? This is so easy. All right, so you have to do 3 properties, run the basic analysis on them, complete the homework or complete the workbook, and then post the picture of your completed workbook in the homework post. Okay, so post it in the homework post. Extra credit. And we'll go back to number 4 in the homework in a minute. Extra credit. The first extra credit, which is going to count for a huge bonus, because it helps us. It helps other people in the group get to know us through you. It's one thing if we say, oh, we're so great, which we don't say that, but it's a different thing if someone else says, oh, wow, I really got a lot out of it. People are going to always believe and trust that more, especially if it's just from the heart and it's sincere, than the people who are talking about themselves and their own Facebook group. All right. So we're asking, in order to get the bonus points, and even if you're not going for the scholarship, if you feel like we've delivered a lot of value this week, I hope you feel that way. We've poured our heart and soul and all of our sleep into this. But if you feel like you've gotten a lot of value this week and that we've really helped you move forward, we would really appreciate it if you would just do, a video testimonial, and just from your heart. There's nothing I could even coach you on what to say. Just, who are you, and maybe why did you do the challenge, and what was your favorite part, or what did you get out of it, and would you recommend other people to come and check it out? Something along those lines. Just you. So you could do it ideally in landscape. So you could just do like selfie, landscape, video, and post it in the group. That'll be worth 10 whopping points. Another one, I know some of you already done it because I've seen some of the comments. In order to get the bonus points on here, I just want to point out, you have to actually leave a comment, because that's how we get notified that you've watched it, because we see the comment. Plus your comments have actually been pretty funny so far, some of you who've watched it. But Jen did a stage talk last year that was just, it was incredible. Actually, anytime I've ever seen her do any kind of speaking engagement, her ability to speak is phenomenal. She is an incredible storyteller and really helps you to feel everything that she was going through, when she's talking about an experience. Well, the experience that she's talking about in this particular talk that I want you guys to go and watch is probably the most difficult time that we've ever had in real estate, which happened fairly recently. It's been a couple of years now, but it was fairly recent, and it was the biggest hurdle we've ever had to overcome. And it was her doing a stage talk at the Sue Talks, which is like TED Talks, but it's a different organization, Sue Talks. And it was about that journey and how to overcome it. And anyway, I want you guys to watch it. And I just feel like there's so much value in just understanding that, look, all the stuff that we're sharing with you, we've been through it too. We've been through hard, difficult situations and had to somehow work through them. So it's awesome. It's like 12 minutes. It's not very long, but it's powerful. And you get to kind of see a different side of Jen, and you're just going to love it. Anyway, so the link is right there. It's also in your self-scoring tally sheet. And so after you watch it, leave a comment, and then you get to record your 3 points. And again, even if you're not going for the scholarship, go watch it. Trust me, you want to. All right. Something else that's not in your workbook, but I actually just thought of today, this morning as I was getting everything ready was, we've been sending you emails during this week. And I know some of you probably been getting them, and some of you probably been like, what, emails? I haven't seen any emails, which tells me that our emails are going into your spam. And as we go forward, there's going to be times where we want to send you something, or hey, we did a new class, or hey, we just created this new tool for our apartments, and we're going to want to send it to you. If our emails are going into your spam, you're never going to get it. And that is not the point. We want to make sure we can be in communication with you and you with us. So I'm going to give you 2 bonus points. What I want you to do is I want you to go into your email, and any of the emails that we've sent out this week, I want you to go in and just reply to one of them. You could be like, hey, Jen and Stacy, and what I'd love to know, if you don't mind taking a minute, is what was your favorite part of the challenge? Like, what was the part that made the most difference to you? Or what was your favorite part? Just, let us hear from you. And if you go and you find the email and it's not in your regular inbox, let's say you have Gmail and it's in your promotions or it's in your social, make sure you go move it over into your regular primary inbox, because otherwise everything we send you in the future, you're never going to see it. Same thing, if you end up finding it in your spam or junk mail, then say that it's not spam, or do something, move it into your inbox so that the future emails you actually still get from us. All right, so that's 2 points. And then finally, I want you to go into events, and I want you to find the event that's next Tuesday. I would highly encourage you guys to sign up for the Monday Warrior Mindset training, by the way, that Jen does. It's at 3 p.m. Pacific, 6 p.m. Eastern on Monday. That's also in the events. But I want you to go and register for the asset protection interview. That's on Tuesday at 11 a.m. I'm giving you 2 points to do that. And I know that sometimes not everybody can make it live. That's okay. But if you register for it, you're going to at least get the notification, and then you can go back and watch it later. We just feel very strongly that if you're going to get into apartment investing, you really need to start having some kind of base knowledge of asset protection. And I have literally the best person in the United States coming to speak to you. In fact, one, I've known Clint for a long time, and we do work with Anderson Advisors for our own real estate. But I was at a networking event a couple of years ago that had over 1,000 people. It was huge, and it was all apartment investors. It's this huge networking event in Boston, and I was just there attending. And then who do I see on stage? Clint. And I was like, oh my gosh, you really are everywhere. And he's just extremely highly sought after, because he is an expert in real estate investing, asset protection. So the fact that I was able to get him to come and do an interview with me is a really big deal. And I really want you guys to be there. So anyway, I'm giving you bonus points for you to go and register. So that's everything. Going back up to number 4 in homework, what you need to do now, complete the self-scoring tally sheet. And I want you to, get all your points on there that you got, and then send it to our admin. When you send the message to the admin, put in there total points, like just type it in, however many points is your total points. And of course, with the extra bonus points that we just added on, you're going to have to just type that in, insert it, type it in, do something. And because we created it before we had these extra points. All right, so send her the tally sheet, send her the total points, and then tomorrow, day 5, we will be announcing the scholarship winner. All right, so for the scholarship contest, to win, you have to have completed all the homework. So if you somehow managed to have the most points, but you didn't do all the homework, you can't win the scholarship. Okay, so remember, in order to get the points for the homework each day, you have to have posted it before midnight on that day. Okay, you can still win the scholarship without it being at midnight, but those extra points help you get there. Basically, it's simple. The most points wins. So the last time we did a challenge, it was the top 5 people were all within
they were all 1 point
away
apart
from each other. Yeah, they were all 1 point apart. I was like, oh my God, this is painful.
Literally, contribution points were the only thing that solved it.
That's what it was. It was the contribution points that ended up making the difference. So anyway, do your tally sheet, send it into our admin, and also attach it to the scholarship contest post that's going to be in the units today. All right, we are going to go through, well, probably mostly our admin, but our team is going to go through and verify and validate all entries and determine the winner. So make sure you are buttoning up all of your extra credit. Make sure it's all done, all documented, and we'll see who's going to win the scholarship. So just to remind you guys, like, what's at stake? I mean, to me, I look at it and I'm like, you know what? The real value to me is just everything that you're learning and actually doing for you and your business. That's like the biggest win to me. But since we are talking about a scholarship contest, the scholarship is for 12 weeks being a part of the Cash Flow Coliseum Mastermind and the Apartment Gladiator Mastermind. That's just, it's a BFD. So we have 2 masterminds every week. They're usually an hour and a half to 2 hours, sometimes a little bit longer. And one is focused on really all areas of real estate investing. And then one is focused specifically just on apartments. So basically you get to come to 24 mastermind meetings if you come to all of them in the 12 weeks. And during the time that you're in our 12-week mastermind, you are going to have full access to our apartment investing course. So anyway, it's a big deal, and I'm really excited for whoever's gonna win it. All right. So tomorrow, same time, same place, we're going to be talking about just putting it all together, right? There's a lot of different pieces to apartment investing, and we've covered a handful of them at a very, very deep level, but there's a lot of other pieces. So we're going to talk about the rest of those pieces and just really start talking about your path to freedom plan so that you can take the momentum that's created in this challenge and go make something happen with it. So we love you guys. You're amazing. The fact that you're still here says a lot about your commitment to yourself, your why, and your future, and creating the future that you want on your terms. And we are exceptionally grateful that you've entrusted us with your time so that we could help you get there. All right, guys, have an amazing Thursday, and we will see you tomorrow.